Hey class, welcome to lesson 3. So far in this section, we've talked about Social Security timing and taxation and how those differ and they can work together. And then we've also talked about the provisional income, which is how the IRS determines how much of our Social Security is taxable. In this lesson, I want to give you a few ideas about how to reduce some of your Social Security taxation, either now or into the future. I'm going to use this graph to kind of walk through a couple of different thoughts. The first two items on the top of this graph are a Roth IRA and a Roth 401k. Both of these accounts are types of accounts that do not count against your provisional income. Either of these accounts, if you have a balance in your retirement years and you use these for supplemental income or one-off distributions or withdrawals, do not count against your provisional income. So this is an easy way to have higher income, however, stay in a lower Social Security taxation. This next item on this graph is a Roth conversion. I wanted to bring this topic up here to explain how to move monies from an IRA or a tax-deferred account into a Roth IRA or a tax-exempt account. A Roth conversion is when we take any amount from your IRA account and transfer it into your Roth account and pay taxes through that transfer. For example, if you have $100,000 inside of your IRA and we want to do a Roth conversion into your Roth IRA, the most common type of conversion is where we take that $100,000, withhold taxes, let's call it 20%, withhold $20,000 for taxes, and deposit the remaining $80,000 into your Roth IRA. So that's an example of a Roth conversion. When planned for appropriately several years before retirement, oftentimes the ideal window is 5 to 8 years before retirement, a Roth conversion can be a very powerful tool if you understand your tax story to be able to pay a lower tax when you know what the lower tax is and to avoid a higher tax environment later on throughout your retirement. So that's what a Roth conversion is. The last item that I want to mention on this graph is a properly structured cash value life insurance policy. You might be asking, a life insurance policy, Devin, what does this have to do with anything when we're talking about Social Security taxation? Well, a cash value life insurance policy is oftentimes called a rich man's Roth. Essentially, life insurance companies have lobbied for the tax characteristics that are very similar in this policy as a Roth IRA. So if you have cash inside of one of these policies, it grows tax-free, and with your withdrawals are tax-free coming out. So essentially, this type of account does not count against provisional income. And this type of income can be used throughout retirement to reduce the percentage of your Social Security that is taxed. As we continue on in this topic, I want to ask you this question. What are the greatest causes of Social Security taxation? Well, the answer is actually pretty simple. It's having too much money in an IRA or a 401k, or too much income coming from a pension or real estate assets or other income sources. So for you as a student coming through this retirement taxation masterclass, an important concept that we'll address is, do you have too much in a 401k or an IRA, or do you have a pension that is causing higher than normal or higher than needed percentage of your Social Security to be taxed? In the next lesson, we're actually going to talk about the impact of a pension and an RMD on your Social Security taxation. We'll see you in the next lesson.